Welcome to our video on the 2008 financial crisis, one of the most severe and widespread economic crises of the 21st century. In this video, we will take a closer look at the causes and effects of the crisis, and discuss what steps can be taken to reduce the risk of another crisis in the future. From the housing market bubble in the US to the lack of regulation and oversight in the financial industry, we will explore the complex factors that contributed to the crisis. Join us as we delve into the past and examine what lessons can be learned for the future.
The 2008 financial crisis was a major global economic downturn that began in the United States and quickly spread to other countries around the world. The crisis was caused by a number of factors, including a housing market bubble, risky lending practices, and a lack of regulation in the financial industry.
The crisis began to unfold in 2007, when the U.S. housing market began to decline. As housing prices dropped, many homeowners found themselves owing more on their mortgages than their homes were worth. This led to a wave of foreclosures, which in turn caused the value of mortgage-backed securities to drop. Many financial institutions, which had invested heavily in these securities, found themselves in serious trouble.
The crisis reached a critical point in September 2008, when the investment bank Lehman Brothers filed for bankruptcy. This event triggered a panic in the financial markets, as investors and lenders worried about the solvency of other financial institutions. Banks and other companies around the world found it difficult to borrow money or raise capital, which made it difficult for them to continue doing business.
The 2008 financial crisis is also commonly referred to as the global financial crisis or Great Recession, as it affected not only the United States but many countries around the world. The crisis can also be referred to as the credit crunch or subprime crisis, as the crisis was largely triggered by the collapse of the subprime mortgage market in the U.S. The term Lehman Brothers moment, also occasionally used as the bankruptcy of Lehman Brothers, was a key event that accelerated the crisis.
The 2008 financial crisis was particularly severe and widespread for several reasons. First, the interconnectedness of the global financial system meant that the crisis spread quickly from one country to another. Second, the use of complex financial instruments such as mortgage-backed securities and collateralized debt obligations made it difficult for investors and regulators to fully understand the risks involved. Third, there was a lack of oversight and regulation in the financial industry, which allowed risky lending practices to go unchecked. Fourth, many financial institutions had high levels of debt or leverage, which made them more vulnerable to losses. Fifth, the housing market bubble in the U.S., driven by low interest rates, lax lending standards, and speculation, was a major contributor to the crisis. Sixth, deregulation of the financial sector in the U.S. and other countries enabled banks and other financial institutions to take on excessive risk. Seventh, the crisis had a ripple effect, as the failure of one financial institution led to others being impacted. Finally, there was a lack of coordination among central banks and governments, which made it difficult to effectively respond to the crisis. These particularities made the 2008 financial crisis one of the most severe and widespread economic crises of the 21st century.
There are several steps that can be taken to reduce the risk of another financial crisis like the one that occurred in 2008. First, governments and regulatory bodies should strengthen oversight of the financial industry and implement regulations to prevent risky lending practices and the use of complex financial instruments. Second, financial institutions should be required to disclose more information about their operations and risk exposures to help regulators and investors better understand the risks involved. Third, financial institutions should be required to have robust risk management systems in place to identify and manage potential risks. Fourth, banks should be required to hold more capital to protect against losses in case of a crisis. Fifth, banks should be subject to regular stress tests to ensure they can withstand severe economic downturns. Sixth, government should put in place laws to protect consumers from predatory lending practices. Seventh, international cooperation is needed to ensure that financial regulations are consistent across borders and that regulators can work together to address risks. Eighth, governments and regulatory bodies need to have a broader perspective and take into account the overall stability of the financial system. Finally, governments and regulatory bodies need to have early warning systems in place to detect and address potential threats to the financial system before they become severe. While it is not possible to completely eliminate the risk of another financial crisis, implementing these measures can help to reduce the risk and mitigate the impact of any future crisis.
One aspect of the 2008 financial crisis that may not be widely known is the role played by the ratings agencies. Ratings agencies such as Moody's and Standard & Poor's are responsible for assessing the creditworthiness of securities, such as mortgage-backed securities, and assigning them a rating. However, during the lead-up to the crisis, many of these agencies gave high ratings to securities that were actually very risky. This gave investors a false sense of security and contributed to the widespread purchase of these securities by financial institutions.
To conclude, the 2008 financial crisis was a wake-up call for government regulators and financial industry players on the need to have better oversight and regulations. The crisis had a major impact on the global economy, and the ripple effect was felt by millions of people around the world. However, by implementing stricter regulations, increased transparency, and robust risk management systems, we can work to reduce the risk of another financial crisis in the future. Thank you for watching our video on the 2008 financial crisis. We hope you found it informative and insightful.